Hi everyone, my name is Megas and I'm a Canadian investor. I like to read about personal finance and investing to help learn and guide my investment decisions. I know that with so much information available online, it can be difficult to know where to begin. So I decided to start a series where I discuss basic financial concepts and ideas that specifically are geared towards Canadians. This video will be about ETFs, what to look out for, what you want to see when you're purchasing an ETF, and how you can use ETFs to make you money. An ETF, or exchange traded fund, is a group of assets like stocks and bonds that can be traded on an exchange. Since ETFs are traded throughout the day, they can be bought and sold at any time that the stock market is open. And because they're traded throughout the day, their prices will fluctuate based on the assets that they contain. There are two types of ETFs, each with a different method for determining what group of assets to own. These two types of ETFs are passively managed ETFs and actively managed ETFs. Passively managed funds are usually index funds, which just means that they aim to mirror the performance of an index like the S&P 500. Other common indexes that you might have heard of are the S&P TSX Composite Index or the NASDAQ 100. Passively managed ETFs can also track a sector of the economy, like commodities or financials. On the other hand, an actively managed ETF doesn't track an index. Instead, it owns its group of investments based on the decisions of its fund manager. These days, the most well-known examples of ETFs that follow an active strategy are Cathie Wood's ARK Innovation funds. Actively managed ETFs have higher fees associated with them because they have to pay for researchers and analysts that help guide the fund managers' investment-making decisions. These fees can really eat into the investor's returns and usually should be avoided. Diversification is another huge benefit of exchange-traded funds, and they offer more diversification than an investor can get on their own. Diversification is a risk management concept that improves the consistency of your returns while decreasing your risk. When owning an ETF that tracks a broad market, investors can own hundreds or even thousands of individual investments across different sectors, asset classes, and geographies. However, the risk of losing money when investing in the stock market always exists. Before investing, investors should take a look at their risk tolerance, their financial goals, and how long they plan on keeping their money invested. If considering an ETF as an investment, it is also important to keep in mind the risk profile of the assets that the ETF contains. Generally, ETFs that contain more stocks carry more risk, and ETFs that contain more bonds carry less risk. An investor can earn returns in two ways when it comes to investing in ETFs, and that's through capital appreciation and dividends. Capital appreciation is basically the increase in the price of a stock. When the investments within an ETF increase in price, the value of your ETF will also increase in price. A dividend is a cash payout that a company pays to its shareholders, usually in regular intervals such as monthly or quarterly. But it's important to note that not all ETFs pay a dividend. You can find out if an ETF pays a dividend by reading its prospectus. And the prospectus is kind of the detailed ins and outs of how an ETF operates. Other than the opportunity for diversification that ETFs offer to investors, another factor that makes ETFs a good choice are their low fees. This is especially true when engaging in a passive strategy like index investing. The iShares Core S&P TSX Cap Composite Index ETF, ticker symbol XIC, has a management expense ratio or annual fees of 0.06%. The Vanguard S&P Index, ticker symbol VFV, has annual fees of 0.08%. Both of these market ETFs can be purchased in Canadian dollars and offer exposure to the majority of Canadian and American markets respectively. Because of the low expense ratios, an investor of $1,000 into these ETFs would pay roughly 60 cents to 80 cents to manage their investment and in return get a significant diversification benefit across Canada and the United States. Investors can also limit the amount of fees they pay by choosing a broker that offers low or no fees when it comes to investing. An example of a brokerage in Canada that offers free ETF trades is Wealthsimple Trade. Other brokers such as Questrade and Virtual Brokers offer free ETF purchases but charge about $5 when it comes time to sell. Many banks charge even more, about $7 to $10 when you're buying and selling ETFs. Some brokers also charge a fee if you don't trade often enough, or if your account balance falls below a certain threshold. Lower fees are related to total returns when it comes to investing. By keeping fees low and incorporating broad diversification, you can use ETFs to make your money make you money. In summary, ETFs are funds that are traded on an exchange. Usually they are index funds or funds that aim to mirror the returns of an index. ETFs that have this strategy are known as passively managed, and usually have lower fees than actively managed ETFs that employ more complicated strategies. When choosing an ETF to maximize returns while minimizing risks, you want to purchase a broadly diversified ETF that has a low management expense ratio, preferably a low-cost index fund. Some examples of these are the iShares ETF XIC and the Vanguard ETF VFV. It also helps if you don't trade in and out of your ETF so that you can minimize the fees paid. Thanks for watching. My name is Megas with Megas Money. If you enjoyed watching this video, please consider sharing it with a friend who might be interested in learning something about ETFs. Let me know of any ETFs you've bought or are considering buying in the comments below.